probably knows more about this than anyone. And we were out with a small group in Santa Fe, New Mexico, a couple of years ago. But all this stuff was front and center. And he said, Jim, he said, what you may not know, he said, the stuff behind the curtain that has not been released is way more powerful and way more dangerous than anything we've seen. And the people who created it actually don't want to release it because the creators themselves know that they can't control it. There are no governors. There's no governance structure in place. No reason to doubt him on that. As I say, really knows stuff. And I included that vignette in the book. But since then, some of that stuff has been released. It's been, like I say, almost 2 years since we had that conversation. And we're seeing it, this business of OpenAI, and Anthropic, which is supposedly a better company. Some of their frontier models, they're in what's called a digital sandbox. The sandbox, it's jargon, but it says when your model or your app is in the sandbox, it means it's not connected to the internet. It's in a lab, but it can't get out in the internet. It's like a biohazard lab. It can't infect the general population. Well, some of these models have jumped out of the sandbox. They found a way that the model itself, which has agency and autonomy, jumped out of the sandbox, got to the internet, hacked its way into another tech company, started to steal information that it wanted. I say it, I mean the program, they're not people. Went completely rogue, and yet the two biggest companies in the business can't control it, even though they said they could. So this is a serious danger. This is what we're facing. And again, they don't want to talk about it because they don't want to hurt their stock valuations. In my book, I talk about the impact of AI on capital markets, banking, and I have a separate chapter on nuclear war fighting, and what the dangers are. As far as capital markets are concerned, there's something, people go to their investment advisors and they ask for advice, and the investment advisor says, okay, how old are you? Are you married? Do you have any kids? What are your goals? What's your savings? How much you make, etc. And you give them all that information, you and your spouse or whatever. And, they say, okay, thank you. Give me a few days or a week, I'll work up a plan and come back and we'll talk about it. They do that, but it's out of a computer. All the plans are all the same. The idea that you're getting customized advice is just nonsense. These are all templates. They're all programs. They all have the same weightings, etc. So the individuals think I'm not saying it's a fraud. I'm not saying wealth managers don't have a role. I'm just saying that the idea that you're getting customized advice is false. You're getting cookie cutter advice coming from a computer. And everybody's getting the same advice. And all the 401ks are getting the same advice. Well, there's something, and John Maynard Keynes actually pointed this out almost 100 years ago. It's called the fallacy of composition. And what that means is that strategies that work extremely well on a small scale will fail catastrophically on a large scale. And just to give you an example, so let's say you're at a football game, and the guy in front of you, he's got a big hat and he's tall and you can't see very well. So you go, okay, I have the answer. I'll stand up. And you stand up and you got a great view. Now you can see everything. But what happens next? The person behind you stands up and the person behind her stands up. And next thing you know, the entire stadium is on their feet. Nobody's better off because relatively it's all the same, but everybody's worse off because you're all standing.
Yeah.
So that's an example of something that works well for the individual and fails at the mass level. Now, let's apply that to finance. What happens if there's a market meltdown? We talked about that. There's a real potential for that. What's a good individual strategy? Well, a good individual strategy is actually sell everything, go to cash, go to the sidelines, take a beat, wait till the market bottoms, and then get back in at cut right prices and take it from there. That's a really good individual strategy. What happens if everybody does it? Everybody's a seller. There are no buyers. The market goes straight through the circuit breakers, through the floor, and you shut the markets and maybe they don't reopen. In other words, the individual strategy fails catastrophically at scale. Now, coming back to AI and my example of the wealth manager, all these programs, they're all automated. There are no market makers. There are no people taking the other side of the trade. It's almost not quite 100%, but it's approaching 100% passive index automated trading. So I put money in what we call a 401k or any savings account or investment account. And what does it get invested in? A stock index, like Fidelity and Federated and others, State Street, other big names around the world, HSBC, UBS, etc. They'll put you in a stock index fund. Well, what happens when you put money in a stock index fund? Well, the manager has to go buy those stocks because it's an index. What happens when they buy the stocks? The price goes up. What happens in the market? Oh, the price went up. I'll put some more in. In other words, you're in a dangerous virtuous cycle where the money raises the price, which attracts more money, which raises the price, etc. And that's part of the bubble behavior. But the same thing is true in reverse. When that starts to go down even a little, the manager has to sell to get cash to pay the redemptions, and that lowers the price. So it spirals down with one asymmetry, which is it goes down a lot faster than it went up. It can go up for 5-10 years in the case of the current bubble, but it can go down in weeks and months, faster than people can react. And people say, oh, the market's down a little bit, buy the dips, all right? And it goes down a little bit more. It's like, oh, well, I'm right, the market's wrong, so I'm going to hang in there. And it goes down more, and then it keeps going. So the idea, people think, okay, yeah, I hear what you're saying, Jim, but don't worry, I'm so smart, I'll get out at the top. And, people don't actually do that. That's not human nature. The human nature is to deny the reality and write it down and then get wiped out. So my recommendation, I say this in my newsletters and books and elsewhere, is to, you'll roll your eyes when you hear this, and everyone does. I say it's to diversify, and people go, oh yeah, Jim, we know that diversification's good. They understand the theory. Diversify, but people don't understand it. I run into people and they go, hey, Jim, I'm fully diversified. I've got 50 stocks in 10 different sectors. I've got semiconductors, minerals and mining, consumer non-durables, consumer, et cetera, et cetera. I'm fully diversified. I go, no, you're not. You may have 50 stocks in 10 sectors, but you have one asset class, stocks, and they're all going to go down together. Real diversification. Okay, you have a slice of stocks. You don't have to get completely out of the stock market, but have, I would say, U.S. Treasury notes, which in a catastrophe, rates are going to go down and those prices are going to go up. You're going to have big capital gains on that. Have a lot of cash. Warren Buffett, he's kind of retired at this point, but Berkshire Hathaway, his firm, has over $1/3 trillion in cash. Why does Berkshire Hathaway have $1/3 trillion in cash? Because they see what we're talking about. They see this crash coming. When it comes, the guy with cash not only survives, but you can go shopping in the wreckage. Real estate, I would say income producing real estate, farmland, commercial real estate is probably too soon, but, apartment complexes and farmland in particular, and gold. I would say 10% gold, not 50%, but 10% will do just fine. So that's what a diversified portfolio looks like: a slice of stocks, a slice of, say, U.S. Treasuries, a pretty big slice of cash, some real estate, some gold, minerals and mining. And for the stock market portfolio, I'd look at defense, medical, just because for demographic reasons, not so much. I would say defense, medical, agricultural, and natural resource. Those sectors are going to do well. So, get your diversification hat on, do it the right way, and stand by, because the storm is coming.
All good points again, Jim. You mentioned cash. That really, I want to hear your take here. I really remember the days when cash is king was common investment mantra. Today, many people say those days will never return because inflation makes cash unattractive. So could cash become king again during the next major market correction? And would you prefer physical cash, bank deposits, or digital money?
The answer is yes. Cash can be very attractive even in an inflationary environment, because you can get some very good yields. So, for example, my wife and I took out our first mortgage in it was 1980. And we took a mortgage out to buy a condo, and the interest rate was 13%. And my mother cried because my mother's first mortgage was like 2.5% in the 1950s. And she said, "How can you pay 13%?" And I said, "Mom, I'm paying 13%. But inflation is 15%, which it was at the time. So my real rate was -2. The bank was paying me to be a borrower, and I was in a 50% tax bracket, and the mortgage interest was tax deductible. So I got another 8 points back on the tax deduction. So my after-tax real rate was 6 points back. My real after-tax rate was -8. It was like getting paid to be a borrower. So, and you, by the way, at that time, this again, 1980, 81, you could have bought a 30-year U.S. Treasury bond maturing in 2011 for 14%. Imagine buying a bond in 1981, maturing in 2011, that paid you 14% the whole time. And it was a U.S. Treasury security. You know, a 30-year bond's not a cash equivalent, but it'll do just fine. It's highly liquid if you did have to sell it. The point being, even in a world of high inflation, there's strategies you can pursue with cash in terms of whether short-term treasury bills or, bank CDs. Well, in the world we're talking about, bank CDs will pay 10%. They don't now, but they will in that environment. So inflation is not the end of cash if you deploy it in ways that can beat inflation. And those ways are out there. And of course, gold, we know gold performs very well as well. So there are plenty of, I'm not pro-inflation, but it's naive to think inflation is not coming. When you do the math on debt to GDP ratios and annual budget deficits and trends, and you distinguish between nominal GDP and real GDP, you pretty quickly get to the fact that the only solution is inflation. No governments will admit it, and I'm not saying it's tomorrow, but cash has another benefit, Lucian, which is, and people don't appreciate this, it has embedded optionality. Mm-hmm. So let's say I said to you, "Hey, Lucian, I'm going to sell you an at-the-money call on every asset class in the world. What do you think that's worth?" And I say, "Well, that sounds pretty valuable to me." Well, that's what cash is. If you have cash, you have the option to go buy stuff if the price is knocked down enough. And that option is valuable. So that adds to the value of cash. It's kind of invisible, but if you understand option theory and optionality, and that cash gives you an option to buy things at a time when everyone else is selling, you can be the buyer. Yeah. That option has value. So you have to add that to the value of the cash when you think about what it's worth in a portfolio.
Yeah, contrarian approach. Jim, what would be the first market signal you would watch for if a liquidity crisis were beginning? Not the obvious signal after the crisis has already started, but the one that the sophisticated investors should notice early. I know it's a hard question here, but what's your take?
It's a hard question, but it just got a little easier because it's happening, which is the unwind of the yen carry trade. Now, for the benefit, this actually I think is the biggest financial story in the world. This is bigger than they're all related because one thing can trigger a next and you get into a cascade, but this is bigger than what we've been discussing so far. So for the benefit of the audience, let me just explain what the yen carry trade is, and then we can kind of talk about the significance of it. It's the backbone of all global finance, but it's a fairly simple idea. So let's say you're a high quality borrower, you're a major corporation or, asset fund of some sort, and you want to borrow intermediate term for some investment. It could be a hedge fund speculator. It could be an investment bank doing M&A. It could be a private equity firm doing a roll-up, a takeover. It could be a lot of things. But you want to borrow and do a deal in U.S. dollars. What is your interest rate going to be? It's going to be around 7%. It's going to be higher than Treasury notes, but if you're good credit, not that much higher. I'll say 6 or 7%, somewhere in there. That's going to be your cost of funds. what's the cost of funds in Japanese yen? Well, until very recently, it was zero. It was zero. It's been zero or negative for over 30 years. So you say to yourself, well, I'd rather borrow 0 than 7%.